Hey everybody, it's Scott with the Davis team here for another Wow Wednesday, Words of Wisdom Wednesday. We're actually going to touch on something that we talked about a month ago, maybe something like that. It's even more prevalent now, and I think education is what we really need to be getting out there. And it's adjustable rate mortgages, ARM loans. Don't run away. Stay with me. Stay with me. It's the education piece that's really important. Historically, even in this low rate market, folks are staying in their homes anywhere, even if they're not selling their homes, they're staying in that loan between 5 and 7 years on the average. Of course, every individual may be a little bit different, but they're refinancing for debt consolidation, they're refinancing to get cash out to buy another home or for renovations or whatever the case may be, or they're getting a shorter term going from a 30 to a 20 or a 15 or even a 10. So an adjustable rate mortgage in this market right now is really something that everyone should be considering at the very least. And it may not be for everyone, but it's my job to make sure that you have all the options and all the education. So I'm gonna get into it real quick. There's 4 components to an ARM. There's a margin, an index, a cap, the different caps, and an initial. And the 4th piece is a really important one because the initial cap period is also the equivalent of the lifetime cap. So a normal cap options are a 5-2-5. So let's say you have a 7-year ARM and they're still 30-year loans, but an ARM is fixed for the period of the ARM, that term. So in the case of a 7-year ARM, it's fixed for 7 years. It doesn't fluctuate, doesn't move, nothing can happen. But if it's a 5-2-5 structure, the initial cap could be 5%. The lifetime, the 2 is the annual percentage after the initial adjustment, and the last 5 is the lifetime cap. So if you have a 7-year ARM at 4.5, the highest it can ever be is 9.5. The lowest it can ever be is the margin, because the index could theoretically be 0, but the margin will always be there. And a normal margin is 2.5. Somewhere between 2 and 2.5 is a normal margin. They get really a little more intricate than a 30-year fixed. That's a disadvantage. Another disadvantage is that it will adjust after that initial period. So if you get a 1-year, a 3-year, or a 5-year, you're only fixed for that period. But if you get a 7-year or a 10-year, you have a lot more options to stay in a home 7 or 10 years without having to worry about your adjustment. And your start rate right now, we're looking at 1% lower than where a 30-year fixed rate is. So that's considerable savings over a 7-year period. If you're saving $100 a month, $1,200 a year, you're saving almost $10,000 of interest. That's pure interest, not anything that you're gaining. Good for me that you're paying the extra interest, bad for you, and I really want to do what I can to save you as much money as possible. So that's kind of a high level, down and dirty. Please give me a call with any questions, because it is something that I think everyone should at least be familiar with or kind of know the ins and outs of the options. So give me a call, 703-209-3138 or scott@davisteam.com, and anything you need, I'm here for you. Have a great week. Talk to you soon, guys. Bye.